I'm here today with Eric Ries. Eric is an author, he's an educator, he's a communicator, he's a founder, he's an entrepreneur. He's a busy dude. And on the author front, he has a new book out called Incorruptible. Eric is so well known for your earlier work, in particular, I think, of the lean startup and the whole movement you authored and created and blew a great deal of life into. What made you think that there was a next chapter in that? It seems to me that in your first big run in the lean movement, that you helped founders build companies. Now it seems to me that you said, okay, now that we built those companies, we have to ask a harder question, which is how do we stop those companies from losing their way once they've had some success?
That is a perfect way of saying it. And yeah, thanks for the kind words. Yeah, I'm immensely proud of everything we in the startup movement and the lean startup movement in particular have accomplished in the last 15 years. We've helped so many people create so many companies, make so much money, change the world in so many different ways. But I've also gotten to see the dark side of this business up close and personal.
The dark side?
Yeah. There's like a dark underbelly of it. And a lot of these companies, although they began with tremendously positive intentions and almost an idealism about the power of a product or a technology or a certain way of working to change the world for the better, a lot of them wound up bureaucratic, malignant, narcissistic, self-serving, or worse. And I've seen so many founders lose control of the companies they create, not just because they got forced out or their board betrayed them. We obviously see that a lot, but also founders for whom they kind of don't understand why their company's behaving the way that it is, cannot figure out how to bind it to the principles that they thought were important. And I think that loss of what makes companies special is both morally and ethically very dangerous, but in particular, it's also economically very destructive. So I wanted to see what we could do about that.
Well, as you look at the massive companies out there, big and small, obviously you're saying some have lost their way. How many do you think lose their way, and does it change at a different point of time? Are they more susceptible to lose their way in the early years, in the mid years, or maybe when they get long in the tooth?
The common wisdom is that this is an inevitable process that happens as companies scale. So most people think it just has to do with how much money is involved or how many people is involved, but the data doesn't support that. In the book, I lay out case studies of this phenomenon happening over the past 200 years. Pretty consistently, people have been trying to build mission-driven companies according to a blueprint I call enlightened capitalism. Right? You basically rediscover in every generation that if you treat employees well, if you're respectful to your customers, if you form long-term partnerships with your investors, everybody makes more money. And these founders who do that generation after generation, they expect that since the market is about competition and rewards value creation, their ideas will spread and their company will be protected. And then they act so betrayed and surprised when the opposite happens instead. Now, I do think the problem is getting worse because thanks to financialization, we have made the finance sector of our economy so much larger than it ever was before, so much so that it's collapsing the distinctions between public and private spheres, civic spheres, even sports, journalism, all the things that our grandparents used to think of as separate domains of human life have now all been collapsed. And so you see people kind of shrug now when it's like, oh yeah, private equity ruined my favorite restaurant. What you gonna do? I had someone the other day, they were going to a restaurant and they said, I really like the owners. I hope they get successful enough to grow, but not successful enough to be bought by private equity. Like it's like the Grim Reaper. But then you hear that sometimes you'll say like, why is your local sports team drive you crazy? Owners out just for money, or people are like, the commissioner only cares about the money for the owners, as if that's like a natural state of affairs. It's like Kennesaw Mountain Landis would like a word. Like there was a time when sports was seen as a separate sphere with its own separate rules. So because we financialize everything, we're getting trapped in this financial gravity.
You've been in the private equity arena for a long time. Private equity isn't private equity. It's a whole bunch of different things. I'm sure there's some firms, and separating private equity from venture, very different kinds of investment profiles and different skill set, it seems to me. I had an experience where I was an investor and then a board member for a company, and it was backed by a really well-known venture firm. And what I learned in that process, I thought I knew quite a bit. I didn't know very much about venture at all, as is evidenced by my track record in investing in those companies. But what I was impressed with this particular venture capital firm, East Coast, West Coast, both, was as this idea, and reading parts of your book just reminded me of this just recently, yesterday, when I was reading through your book, uh, uh, Incorruptible. It reminded me of my encounter with this one venture capital firm, where it kept reminding the founder that the end game wasn't he ran out of money. He wasn't allowed to run out of money. He had to budget himself to an end point which gave him enough money to wind down and settle all of his obligations. And I thought that was very moral and good branding for this firm, because they didn't want to burn vendors, because they wanted to go back to that same vendor community over and over again. And if they had vendors getting burnt by companies who ran out of dough, that wasn't good for anybody. That was a concept I wasn't aware of, being a part of the venture process, but I was impressed by the structure and the discipline that made everyone adhere to, particularly us as board members.
No, that's a sign of someone who understands the business, who's thinking about the long-term consequences of brand, of trust, of reputation. And unfortunately, that is becoming rarer and rarer,
Is it?
because we've found more and more ways for people to make money without creating any value at all. So I'm not against private equity or venture. First of all, many of my best friends are in those businesses. They've been tremendous supporters of mine. So who am I to say that they're bad? But also, I've seen up close and personal how powerful a long-term partnership with a good investor can be, one who aligns interests. And the way you can tell the difference between what I consider to be a good faith actor and a bad faith actor in this business is, are they making decisions that are about growing the pie, raising the enterprise value of the company over the long term? Or are they making extractive decisions that are about trading short-term profits for that long-term viability? And unfortunately, we have made it in our economic system easier and easier and easier to make money by extracting or destroying what others have built. So in the book, I tell the story of Saul Price. I'm sure you know the story of FedMart.
But please tell it again.
You have experience in retail. Outside of retail, Saul is not that well known anymore, but he is really the father of modern retail. I mean, he is a titan of industry.
And you referenced Costco a few times as one of the
Costco's a bit
examples.
of a recurring character in the book, and yet I feel like this is like the prehistory of Costco that people are not as aware of as they should be. So, just to tell the story real quick for those who don't know Saul Price trained as a lawyer. And when he was late in his career as a successful lawyer in the 1950s, he decided to try his hand at discount retailing. And as a lawyer, he had this idea that his client, he had what's called a fiduciary duty to his client. So he has to put the client's interest before his own. And when he went into business, he thought, well, if I'm a retailer, who's my client? It's my customer. So I have a fiduciary duty to my customer. There are so many great Saul stories about this. One of my favorites is that his competitors would sometimes try to drive him out of business by creating loss leaders, so selling products at a loss, effectively product dumping. Sell a product at a loss, advertise it in the Sunday Circular, get customers to come to their store instead of to FedMart. Whenever Saul would see that, he would post their own advertisements inside his store and tell his customers, don't buy eggs from me, they're cheaper down the street. Because he's not there to make money, he's there to be a fiduciary for the customer. And as a result, customers trusted him and would drive miles out of their way to shop at a FedMart if they ever could. He practiced capped margins. He paid higher than prevailing wages. He took care of his community. I mean, just all the things you would want from a business leader. That was Saul. His ethos, this kind of interlocking engine of practices, drove FedMart to tremendous success. He took it public, and then the problem started. Because from the moment FedMart was a public company, he was under relentless pressure from investors to extract more value from the trust he had created. They always wanted him to do conventional retail practices, higher prices, faster growth, et cetera, et cetera.
No more fixed margin percentages, huh?
Yeah, they hated the capped margin drives everyone in business crazy. Still about Costco to this day, because we've all been taught that margin is a source of strength. More margin is better. But then like if you go to business schools, in the morning, they'll teach you that more margin is better. In the afternoon, if you go to the innovation class, they'll teach you Jeff Bezos's rule that your margin is my opportunity. So which is it? Is margin a source of strength or margin a source of weakness? Well, Saul understood it to be a source of weakness. Anyway, he took the company private with a syndicate of investors who he thought understood retail better and would get his model, but that didn't help. The investors were constantly on him to grow faster, to abandon the ethos, to adopt more conventional best practices. And so one day in 1975, Saul Price comes into work after building FedMart for 20 years, and the locks on his door have been changed. He doesn't work there anymore. Now, the investors finally got him out, and they finally got what they wanted. What was the consequence? Well, if you know the parable of the person who killed the golden goose, you can probably guess where this is headed. Within 7 years, those investors had driven FedMart into bankruptcy, all in the name of maximizing shareholder value. Now, why would shareholders, generation after generation, do this killing the golden goose behavior when it's value destroying? I thought capitalism was supposed to be about value creation. This is the kind of double mystery of the book. Why does this happen? But then why are there exceptional companies who it doesn't happen to? Now, one of those companies is the successor to FedMart, because after 2 weeks of nursing his wounds, Saul Price was back at work. He actually leased the office space upstairs from FedMart to start his new company, which he called the Price Club. Today, most people don't know the Price Club, but that's because one of his disciples was a guy named Jim McCann, who left the Price Club to found Costco. And the modern Costco was formed when Price Club and the original Costco merged together to form the $400 billion company we all know and love today. So Costco is one of these exceptional companies that both has the ethos of Saul Price. They still practice fiduciary duty to customer. They still practice treating employees well. They still practice cap margins all these years later. And most people don't appreciate how big Costco is. One of my favorite facts about Costco is that if Kirkland Signature, their house brand, was its own separate company, it would be bigger than Nike, Procter & Gamble, United Airlines, or Coca-Cola. Okay, that's how big just their private label businesses.
Wow.
So they're a really, really big company.
So you mentioned something along the way there about enlightened capitalism. And as you've been a student of different economic theories, different economic forms, is there anything better than capitalism that you found? Does socialism ever work?
So this is not a politics book, but I'm a big defender of capitalism. But in order for capitalism to work properly, it requires a certain moral foundation. And this is not my original contribution. Every important economist or thinker about capitalism, going back to Adam Smith or John Locke or even earlier, understood this very essential bedrock philosophy is necessary for capitalism to work. In order for capitalism to work, we have to have voluntary, uncoerced, fully informed transactions. Because only when those criteria are met can we be sure that the transaction creates value. So what I think critics of capitalism often misunderstand is when they see someone who has gained wealth, they assume that that wealth had to be stolen from somebody.
Well,
Fair enough, because we have
the political discourse does bring you there.
I mean, people talk about that all the time, and frankly, we have robber barons. So, like, sometimes it is stolen. Okay, like Al Capone, like, didn't come by his wealth legitimately. So fair,
Hey, easy. He did have a flower shop that he made some money in.
Oh, see, I shouldn't miss. I don't want to speak ill of anyone in the flower business. Okay, so what's interesting to me is when the mechanism of capitalism is working, it's a bit of a magic trick. When you sell me flowers for a price I consider to be fair, both of us are better off after the transaction than before, by definition. Otherwise, we would not have transacted. So value in such a transaction is created. It isn't stolen. And the reason capitalism has lifted so many people out of poverty over so many years is because of this value-creating engine. However, think about all the transactions you can think of in our modern world that don't satisfy this formula, where the buyer is deceived or coerced, where there's mis or disinformation, where we have addiction or 100 other kinds of ways of making money without creating value. So to me, those transactions corrupt the moral logic of capitalism. And actually I think the biggest danger to capitalism today are people who are profiting by those corrupt acts, because they are casting our whole economic system into chaos and raising a new generation of people who have come to associate success in business with this kind of corrupt behavior.
Break out the barbecue and get fired up for a season full of mouth-watering meals. Stock up on gourmet grillers and round out the spread with delicious desserts. Make summer sizzle.
So the moral thread that has to weave through capitalism, it seems to me that what the point you make in Incorruptible is that there are stewards of that morality that have to play their role. And that involves a few things that stood out for me. Making sure that you have the right KPIs, you're looking at the right numbers, the right metrics.
Absolutely.
The other is that the right incentives have to be in place after you have those metrics.
Absolutely.
Talk to me about the metrics. You went into some depth there, and how often how do you get the right metrics? And I heard you do some explanation about column 18B on a spreadsheet, a small little number that's explained in Appendix D might be
Yeah.
the most important metric on that spreadsheet. How do you get to the right ones? How often do you come back to revisit them to make sure they're still the right ones?
Yeah. Yeah. This is a critical thing to get right. In the book, I tell a lot of stories of companies that basically did everything else right, but effed up this bit and still ended up in ruin. Let's start with Johnson and Johnson. I think Johnson & Johnson's a really instructive example because Johnson & Johnson's a great company, great American company, started,
Unique culture, right?
Yeah, very neat culture. And it was a family business. It was why it's called Johnson & Johnson. And Robert Wood Johnson II, he was the kind of tyrant, the second generation owner of Johnson & Johnson, the tyrant that made it what it is today. He was just like Saul Price, extremely uncompromising in his business philosophy. He inherited the company. His father died during the Depression. And so he had worked up from the boiler room to take ownership of the company, and he was relentless. He opened factories at a time when everyone else was closing. He raised wages during the Depression. He was absolutely counterintuitive to his business contemporaries. But as a result, Johnson & Johnson came roaring back to life after the Depression ended. So much so that he took the company public during World War II, I think in the 1940s. Now, even in 1940, he was worried that the company might lose its way once it became a public company, because you know how public markets are. Now, this is 80 years ago, and still he was worried about our public markets. Think how much worse it is today. And so in order to combat this, he created the very famous Johnson & Johnson Our Credo, he called it, which set out his fiduciary hierarchy. Saul Price had a 3-part hierarchy, which was customers first, employees second, shareholders last. The Credo, I think, is 5 points. Patients first, doctors and nurses, our community, our employees, and again, shareholders last. The very best companies who've made the most money for shareholders often have this shareholders last philosophy, because they understand that financial success is the outcome of being trustworthy to these other stakeholders, not the primary goal. Anyway, he was so worried that the company might deviate from the Credo that he had it carved into 10-foot-high limestone blocks and inscribed on the walls of the corporate headquarters, where they stand to this day. His theory was you literally cannot take a job at Johnson & Johnson without walking by the Credo on your way into work every single day. And while he was alive and ruled the company with an iron fist, the Credo held. But once he died, the company gradually began to drift into the allure of our modern best practices: shareholder primacy, competitive benchmarking, and, as you say, metrics and OKRs around growth, profitability, ROI, et cetera, et cetera, et cetera. So much so that eventually the company's trustworthiness collapsed, and it started to get embroiled in scandal after scandal after scandal. You can pick your favorite of these. I think the clear winner for worst of the scandals is when they put asbestos in the baby powder and then tried to cover it up. We know that they did that because there was massive litigation, and the documents all eventually became public. Now, you got to ask yourself, how could a company where the Credo literally says patients first put asbestos in the baby powder, the people who did that walked by the Credo on the wall every day to their way to work, where they then hid the evidence that they were putting carcinogens in a product for babies? How? And the answer is metrics. When you start to build a company around what Seth Godin calls false proxies, in the academic literature, they call this surrogation, where the metric becomes a surrogate for the thing itself. I'll explain what that means. Everyone knows that a healthy company will have a high stock price. Stock price will grow because the company's growing. People see that and say, I see, stock price growing is the goal. So anything that makes the stock price go up must mean an indicator of a healthy company. See the error?
Yes. So the metric, it's emphasis on the wrong metric.
The metric rather than the thing itself. So, for example, in customer service, companies in America have spent billions of dollars, I don't have to tell you, on building out massive apparatus to do professionalization of customer service, phone trees, dial in, all this stuff. On average, customer service today is twice as bad as it was 50 years ago, even though all the metrics of customer service efficiency have gone up, have been improved in that time. Why? Surrogation is your answer again. The false proxy of average hold time is easy to make it look better if you make customers give up in disgust, or better yet, don't even call in the first place. So again, customer service is getting worse while the metric improves. So in order to avoid that, yes, you're exactly right. We have to find what I call holistic metrics that allow us to measure what really matters and to balance out a complete understanding of our impact on the customer. rather than just one narrow slice of their experience.
Who do you place that responsibility on, Eric, in terms of the guardians of the core, the guardians of the people seeking out the truth of what the mission
Yes, the
is?
truth is it's a critical word. Yeah.
So you talk a lot about short-termism, and especially in the public markets, and we see evidence of that everywhere, every day, including the fact that the number of public companies has been halved in the last 30 years. You talk a lot about bureaucracy. You talk a lot about cultural drift. Uh, a favorite topic of mine recently, especially as we look at everything, you can't have a conversation as long as we've had without AI coming into the question. It seems like it's changing everything. It seems like there's a lot of people who will be tempted to chase the wrong KPI or the wrong OKR as they're looking to embrace AI. They want to be contemporary. They don't want to be left behind. What role does the board play? Private, public? It seems to me the board's role, and I've been privileged to be on a few boards over time. There's always that balance between strategy and governance. Governance is easy. There's a checklist, there's boxes, but I think so. We tend to drift as a board to be more focused on the things we can measure about ourselves and the thing we know we're going to be measured upon. So we focus a lot more on the governance part and not enough on the talent, the mission, and the strategy.
Amen. Oh, can I get an amen? I couldn't agree with that more. I think, frankly, the way that most boards practice governance today is like not just extremely ineffective, but it's super boring also, because we're just treating governance like a checklist exercise, and we're avoiding the interesting and most vital topics and responsibilities of a board. So actually, in this book, I call for what I call the new governance, which is instead of seeing governance only as a compliance checklist, it should be a composite of 4 responsibilities, what I consider the sacred responsibilities of the board. One is, of course, compliance. We're not getting rid of that. It's very important to be compliant with regulations. But as you say, that's the easy part. The next question is, what is the corporate purpose? What is the mission or purpose of the company? Why does it exist? Why does it exist? And how do employees and everyone the company touches, how do they know what they're supposed to do? This is, I think, a very sad state of affairs where, starting in the 1980s especially, most companies have fallen under the sway of what's called shareholder primacy, which, instead of seeing an organization as a vital, beautiful, living thing, we see it only as a financial instrument designed to maximize shareholder returns. This is an idea that has been catastrophically bad. We can obviously talk about the reasons why. So as soon as a business wants to do any particular thing, quality, beauty, health, if it cares about any particular thing, no matter how humble, some like, I just want to make my neighborhood a better place. If it's anything but shareholder value, then that business is a business revolutionary, whether it wants to be or not, because it is at odds with this dominant finance-driven culture. So we need to see the board as the guardian of this mission, the guardian of this purpose.
The board, on the board's checklist, it's not just governance and strategy, but you're suggesting there are a couple other things that come before you get to strategy, because you have to answer other questions before you can talk about the strategy, correct?
Yeah, exactly. If you look at most strategy textbooks, they are full of disdain for most companies who don't even have a strategy, because they can't communicate in a coherent way to their employees what they're supposed to do. So that's the third of the sacred board responsibilities after compliance and purpose is what I call coherence. To what degree is the entire enterprise, every resource under its command, aligned around a common activities? Most modern companies are full of factional infighting, political nonsense. It's rough. And as a result, their strategy is being pulled in many different directions. And that incoherence allows corruption to sneak in. I'll tell you a story if you want.
Please.
There was a company, a healthcare company a couple of years ago, big, successful venture-backed tech company that got caught up in the Purdue Pharma scandal. That's why we have the documents. A lot of the stories in the book, like, we have the documents because eventually this kind of corruption leads to legal action.
Yeah.
And so then the documents come out. And this was a company that was selling software to doctors to help them manage their health records and patient bookings and stuff like that. And Purdue Pharma came to them and offered them money to promote opioids to the doctors, so the doctors would promote it to the customers. And when this was found out, of course, everybody abandoned the company and they were driven into bankruptcy. And what's really interesting to me about it is, first of all, they took the bribe, but it was only $1 million. This is like a company with a multi-$100 million valuation. So it was like a paltry amount of money to betray everything they stood for. And so you got to, like, imagine you're in this meeting where someone says, guys, because, Purdue Pharma weren't known to be villains at the time, but these guys want to give us $1 million to pump drugs at our doc. Like, in order to say yes to that deal, the person who signed the paper had to have in their mind their idea that the job of a manager in a company is to make money by whatever means necessary. There's absolutely no way to justify taking this money from a purpose perspective. Like, how does it advance the mission of the company? How does it help? And no one is helped. It's just a quick cash grab. And this idea infects a lot of companies where, like, some part of the organization might be moving forward towards the mission, but another one's just trying to grab every dollar they can. And so the company's marketing message might be one thing, but its employment brand might be another thing. Investor relations is telling yet another story. The company's trying to be 12 different things to 12 different constituencies, compared to, think of a Patagonia, where every employee, every action, every piece of decoration, everything sings from the same hymnal.
Mm-hmm.
So that's coherence as a board responsibility. And the last responsibility of the new governance is what I call integrity. This is the most important one. If you talk to the Costco board, there's all these quotes where they see their job, their responsibility is to act as a buffer, a bulwark against outside pressure, shielding management from investors who want them to abandon the ethos. So seeing your job as creating a protective layer, maintaining the structural integrity of the organization, is actually the opposite of what is today taught as a governance best practice. As a result, Costco has routinely been given the worst possible governance rating by governance rating agencies, even though it is one of the highest performing companies on the entire S&P.
Is that right? I never realized that.
Yeah. Costco is a perennial target of activist investors and hedge funds and governance experts who call their governance structure bad. One of my favorite campaigns, it was driven by a coalition of people that included the Harvard Shareholder Rights Project. So this is being done in the name of shareholders. They were attacking Costco for having what's called a classified board, which is kind of a technical thing in governance.
Yep.
Anyway, it's basically they wanted more shareholder involvement in Costco's decision-making. Costco wants less. So they did this attack. And if you read their filings, they say, why should you get rid of this classified board? Well, if you're overly protective of management, that leads to entrenchment. Entrenchment leads to poor performance. I was like, oh yes, Costco, of all the things you can criticize it for, I'm sure poor performance is one of the things. It was like their ideological blinders had taken them over so completely that they were accusing one of the highest performing companies in the whole country of poor performance. Luckily, their campaign failed.
When other factors come onto the table of things for managers and board members to consider, what do you think roles like those rating agencies, what role they play? And I was asked a question recently about, with this last year being a whole de-emphasis of DEI initiatives, how do you think things have changed? And I said, as I reflect on it, the managements and boards that I'm familiar with, and there's, let's call it a couple of dozen companies, I don't think much has changed. I think what you have is a bit of relief that you don't have these third parties with these less than clear agendas, looking over your shoulder, using a cudgel to beat you into behaving in ways that they think you should. I would say that the managements that I'm familiar with have incorporated the right thing to do, and they don't need someone standing there with a report card at the end of the day. I think it's been internalized, and I see people behaving, saying, I'm going to do this because it's the right thing to do, not because some third party, who, by the way, has an agenda, is going to be over there berating you or creating false impressions about your behavior. I think the intention is good, and it just doesn't need the guardian and the self-serving guardian that crept up.
You know what I think is really interesting is if you look at the companies that were very performative about doing DEI and were subsequently very performative about getting rid of DEI, I would say most customers that I talk to hold those companies in contempt, even the ones who are skeptical of DEI. So, for example, Target was like made a big deal of doing a bunch of anti-DEI stuff at a time when Costco refused. Costco was like, look, we said what we thought it was right when it was unpopular. We thought it was right when it was popular. Now that it's unpopular again, we still think we do what we do, and you can complain. Like they had a shareholder vote about it, and shareholders unanimously backed management on this, even though it was very countercultural. And I've talked to a lot of people about this episode, and I think what's interesting about it is that when companies do the quote unquote right thing, we live in such a polarized time that people think, oh, a company doing the right thing means a company doing what I agree with. So companies are right if they do what I want, and they're wrong if they not. But I think that's totally wrong. I think, again, our grandparents would be like, what are you doing? You guys are very confused. Oh, the company doing the right thing means right according to its own values. So and this is true for a human being or a politician or anybody, when a company stands up for their own beliefs in a consistent way, we respect them, even if we disagree. So if you look at the shareholder vote that backed Costco on its DEI stuff, a bunch of anti-DEI people voted for it because they say this is not what we would choose, but we respect that you're being consistent and you're building a coherent company. Now look at the performance of Costco versus Target from the date that they made those parallel declarations. Costco's like this, Target's like that. Costco's way outperformed.
Yeah.
Again, because customers respond to shows of integrity, and we see that periodically in corporate life, that companies that shift with the wind, that don't have any principles, ultimately underperform.
How will marketing have to change going forward? It's changed so much in the last 20 years in a Google world. It's just changed quite dramatically in the last year or two, again, as Google has changed their rules and policies and procedures. The Google tax seems to be going up and up and up. The customer acquisition cost, all but for very few companies, has really climbed. How will marketing change going forward? And how can it or should it hang on a reflection of the values you talk about?
First of all, I think it's important to understand that the Google and social-driven advertising model is collapsing because consumers are opting out. They no longer trust those platforms to give them neutral information. And that collapse doesn't happen overnight because they're so big and because we don't yet have good alternatives. But part of what's happening, part of the reason you're seeing a massive shift of, for example, SEO traffic out of Google and into AI chatbots, partly that reflects that the AI chatbots are really good, but Google has a chatbot too. People aren't shifting to the Google chatbot. A lot of this reflects the fundamental loss of trust people have in Google because they have polluted the search experience with so much advertising.
And facilitated the bad guys.
Totally made a virtue of the bad guys. It's actually quite sad to see what's happened. In the book, I actually quote a whole bunch of ex-Google people who've been at Google more than 10 years. They write these blog posts when they leave, and you can feel the mourning, the sadness about the fact that although Google is still a great company, it's not what it once was. Something really precious has been lost, although they struggle to put into words what exactly that thing is. For marketing, I really like the marketing guru, Rory Sutherland. He talks a lot about...
He's a great character too, huh?
Great. I mean, just a very entertaining speaker. And his way of speaking is like perfectly optimized for like TikTok shorts and stuff like that.
Yes,
so
it is.
Because like a younger generation that's discovering him for the first
time. By the way, you have quite a presence there too.
Oh, well, thank you. I do my best. But I'm not a tenth as good at it as he is. Anyway, he had this essay recently that was really excellent, I thought, analyzing AI. And he said, look, the issues with AI are almost all extensions of issues we've seen before, but now turbocharged. So the issue has been in corporations for a while now under the shareholder primacy dogma that people who cut costs get rewarded without being held accountable for the long-term brand and marketing consequences of those cost cutting. So if I ruin the quality of the product in the short term, everything gets better. Takes customers a while to realize it. Like I tell the story about the time that Cadbury egg was turned to use inferior chocolate. People in Britain still talk about the great chocolate betrayal of the Cadbury cream egg. It didn't ruin the brand instantly, but over time you see decline as quality is pulled out.
Is Cadbury in the U.S. different than Cadbury in the U.K.?
No, it's the same. It's the same Cadbury everywhere. But unfortunately, because Cadbury lacked its structural integrity, it was actually taken over by the Kraft company a few years ago, and they started to systematically take cost out and therefore take quality out. Cadbury, one of my favorite tidbits in the book, Cadbury had what's called the Royal Warrant, which is like the quality seal of the British monarchy for something like 120 continuous years until the acquisition, until they started taking the quality out of the chocolate and they lost their Royal Warrant. So I mean, it's been sad what's happened since the merger. So we see that a lot where so anyway, because of that asymmetry that we reward cost cutting without accountability for the brand or marketing consequences, AI is primarily being sold as a cost cutting tool. So we're teaching people that the best use of AI is to take people out of the equation. And that is going to be very harmful for marketing. I think part of the issue that's happening is we're seeing marketing channels like devolve into AI slop, but that's no good.
Well, there's no governing body for AI as we know.
No.
But boy, if there was, they should all be fired for the worst marketing job we've ever seen in our lives.
Yeah, it's catastrophically bad.
You know,
And it's sad that there's no joint action, collective action
well,
in governing.
there's another book in you.
Okay, well, one thing at a time.
But let's talk about that moment in AI. It seems to me that we're standing on one side of a pretty fast-moving river, and we're being told on the other side that this AI is going to change everything. Okay, I buy it. I'm a believer. I think it's going to change everything. I don't know how, but I certainly believe that it's going to change everything. And we're told that it's going to have benefits in science and healthcare, but we're also told it's really going to disrupt everything. Everything we do is going to be different. I'm a little uncomfortable with that much change. And I'm saying I need to get to the other side. You're not painting a clear enough picture for me for what that looks like for me. And as I'm a parent and a grandparent, and I just had my daughter and son-in-law stay with us for the weekend with three of our grandkids, the older three grandkids. And we had some interesting conversations, Eric, around one's going to college next year, one's going to high school next year. And we're talking about how do you think AI is going to change your education in the next 24 months? Really interesting conversations. They're old enough now that they're so much fun to be around, and they're thinking and they're probing, and they're just good kids because they have good parents. I don't know how that happened because their grandparents weren't that great. But how do you think you should market to us that don't worry, take my hand, we'll get across the river. There's no bridge yet, so there's no easy way across, and not everybody gets across the river. I get worried about those grandkids of mine. I had the thrill last May to be the commencement speaker at St. John's University in Queens, New York. And I don't go a week now that I don't hear from one or two of those graduates who say, young lady wrote to me, I'm from Queens. I'm still living in my parents' house. I've accumulated a lot of debt to get this wonderful education. And I'm now a much better educated hostess in the same restaurant I've been working in for 3 years. I can't find a job. I worry about the disruption. I buy the premise. I said to my wife the other day, we have to work hard to be healthy, eat right, exercise, do what we can to protect our health, because the health discoveries in the next 5 years, I think, are going to be remarkable. But we have to get there, and those kids have to get to the other side.
We're starting to see very alarming early studies now of kids, for example, who are like outsourcing their thinking to AI and therefore not able to participate in class discussions. People are becoming so enamored with vibe coding, they're turning it into like a slot machine. So this is one of the problems with AI, the way it's currently been constructed and marketed, is that we're teaching people that the power of AI lies in the deliverable, the artifacts it can make for you. And anytime you use AI as a substitute for human agency, you've made a mistake. I really believe that we should only use LLMs as an enhancement of human capabilities.
I try and use it every day. I do use it every day. But I'm not a sophisticated user, but it helps me. I never have a blank piece of paper anymore. I'm a verbal.
Right, exactly. So if you use it to help you develop your own skills, the LLMs can be the greatest teaching technology that has ever been invented. I use it extensively in the research for my book, although I also have benefited from human researchers and fact checkers too. But just the ability to sit down and be like, there's a field of study I want to know more about, teach me. Show me the most relevant
anything you want for free now.
Anything you want to know for free. It's incredible because all of us who write for a living, our work was involuntarily converted into this new form. So we got a lot of things we got to work on, including fair compensation for those whose work powers the thing. Yeah. But also we are headed for, I think, a Chernobyl level disaster as people are using this technology to create artifacts they themselves do not understand. So what's happening, like, it's only a matter of time now before someone vibe codes a piece of software for a piece of critical infrastructure, deploys it without understanding what they've done, and we will get ourselves into a situation that is too complicated for any human being to be able to understand. So like we're going to see that in cybersecurity and all kinds of places.
Well, just this morning, I saw a story that the greatest data breach in history may have just happened in China, where someone took, how many terabits of data out of the Communist Party surveillance system.
Yeah, that's scary.
Very scary.
Yeah, we're going to see a lot. We're going to unfortunately see a lot more of that. I mean, if you look at the Claude Mythos model that was just released.
Well, look at the Anthropic. That's the Anthropic leak.
The Anthropic model.
Half
where
a
they
million
did the
lines
right
of
thing.
code.
Yeah, they did the right thing by inviting security researchers and a bunch of people to get an early preview of it so we can start to harden our infrastructure. But in general, this requires...
The bad guys are going to be ahead for a while.
But it may also empower bad guys. So I think like the fact that we're doing this in such an uncontrolled and sloppy way as a society is a poor choice. And so I'll give you a story that's kind of grim. I don't know, it depends on your point of view. I was at the Vatican of all places. And I mean, what am I doing here? Record scratch moment, 12 feet from the Last Supper, having this meeting.
But by the way, how neat it just feels different when you're in there, don't you?
Oh, it's an incredible. I mean, it just, you feel the history, for better or for worse, radiating off every
scale of things.
Scale, very, very impressive place. And if you don't think too hard about where all that gold inlay came from, then it's really very nice. And listen, the people were there couldn't have been nicer and more earnest in using their power as a convener. And they brought together representatives from all the major AI labs. So I was on this panel with me, and then like representatives from Anthropic, OpenAI, Google, Cohere, Palantir. It was very strange. I was like, what am I doing here? All these people and me.
But how cool is that?
It was cool. It was a really cool experience. And I felt actually very empowered because of all the people on the panel. I was the only one who wasn't accountable to a corporate comms department. So I could say what I wanted. Everyone else had to be extremely careful with what they said. So it was fun. It was a cool experience. But anyway, I mentioned this because two things. One,
I think it's just interesting that the Vatican was convening this.
Yeah. It's of great interest to them because this is a initiative of the previous Pope. Their fear that technology is being built in a way that is contravening human dignity. I think like they are right to be concerned, and so being a moral voice for this to be done properly, I think is a valuable contribution. So every company on that panel has non-standard governance. Not a single one of those companies would believe enough in shareholder primacy to allow shareholders to make the decisions for the control of this most important technology. And I think that reflects our instinctive understanding that this is quite dangerous if we don't get it right. But anyway, at the end of the conference, there were all these young people who clearly had been invited to be like the docents and the kind of staff, people who help facilitate. And they must have been under very strict instructions from the Vatican not to interrupt or bother the speakers during the event, because not a single one of them said one word to me until the moment the event was over. Like it was over at 1:00, and at 1:00:01, I had this like entourage of young people following me around, asking me question after question after question. And a lot of their questions were about what's going to happen. They were mostly local. They were from Rome, so they were Italian students, I think, mostly. And they were very earnest, very interested. They had been clearly following the discussion very carefully. And they kind of were like, sometimes you need out of the mouth of babes, like there's a kind of an emperor has no clothes moment. Because they were like, it sounds like everyone's talking about this very dire moment, but none of the people with power are promising to do anything about it. Did I understand correctly that that's what I saw? And I'm like, yes, you weren't wrong. That is exactly what we are dealing with right now. And they said, look, can you reassure us that it's going to be okay? And I was like, oh, sorry. Yeah, I apologize if you got that impression. It's not going to be okay. I was like, you understand that we are headed for a disaster here. And we have to pray for a right-sized disaster. We hope that AI
disaster. You're so good at
training phrases. That's the best we can hope for, as far as I can tell. But we want to have a Chernobyl moment where as few people as possible die, but as much attention can be paid to the irrational and like very sloppy way in which these technologies are being deployed all over the place. So hopefully when the backlash comes, we don't want it to be so overwhelming that it eradicates the good part of the technology. But we need to be prepared for it. It is inevitable to me that this is going to happen.
Eric Ries, I think with your book Incorruptible, you've lit the fuse on a firecracker that's going to cause people to think about the jobs they're in, the companies they work for. And I think so many more of them will raise their voice now to say, hey, guys, I read this book by this Eric Ries guy, and I just want to state here that I think we're focused on the wrong metrics. We're losing our way. And I think we owe it to ourselves to hit the reset button. I think you've lit the fuse.
Oh, as my grandmother used to say, from your lips to God's ears. That's incredible. Thank you.
I grew up with your grandmother.
I think that's right.
Eric, thanks so much. You've been a delight to talk to. I've learned a lot in reading and preparing for our conversation, so I thank you for the great work you do.
Thank you so much. Thanks for a great conversation.
Thanks, Bob.